Hey everyone, how's it going out there? I've been having a lot of fun doing these educational presentations in addition to the real-time market commentary. So I wanted to talk a little bit about what macro is and why it matters to the market. We're going to have a little fun with this, talk about a couple of the different areas here. We're going to do this live on Twitter and YouTube, so tune in whatever way works best for you. I'll post the YouTube link in just a moment here on Twitter. All right, good stuff. So really the impetus of this presentation is to try to provide a more rounded education for folks about what macro is and why it can matter for the market. I know that there are some that would contend that it doesn't matter. There are others that would say it's the only thing that matters. I take a more nuanced approach. It is one of the things that matters, and it is important, but it's not the only thing that matters. That being said, it will be the focus of today's presentation. And this presentation will be recorded, so you'll be able to check it out later on Twitter and on YouTube. So let's get into it. The way I look at macro is the big picture, right? So we're really looking at some of the broader topics that are moving the economies and that eventually can translate to outcomes in the markets. The key components of macro are the credit cycle, the econometrics, or data like tomorrow's labor market data that we'll be getting, right? That's going to be important as well. There are events that can occur. An example of an event would be like today with Powell's testimony. That's a macro volatility catalyst event. You have fiscal policy, like with the government spending into the Inflation Reduction Act and the Chips and Science Act. Those are powerful fiscal impulses that in many ways offset the impacts of monetary policy. There's geopolitics, right? You have the impact of what's happening with Russia and Ukraine, with what's happening in the Hamas-Israel war in Gaza. You have geopolitical impacts from the Red Sea and otherwise. You also have intermarket dynamics and relationships that can be part of these macro drivers. And of course, last but certainly not least, monetary policy, right? All of these are key areas of macro that we want to watch. So we're going to first start off at the top with the credit cycle. The credit cycle is a critical part of macro because it helps us as investors to understand where we may have better opportunities to invest in the market. So there are four key phases of this credit cycle. There's expansion. Expansion comes with increasing corporate leverage, EBITDA growth peaking, increasing cash flow, narrowing credit spreads, greater investor risk tolerance, and share repurchasing. We have the downturn in the credit cycle. That downturn has increasing leverage, decreasing EBITDA growth, widening credit spreads, and reduced investor risk tolerance, as well as downgrades and defaults. We have the recovery phase of the credit cycle with decreasing leverage, stable EBITDA growth, narrowing credit spreads, and maturity extensions. And finally, we have the repair phase with decreasing leverage, increasing EBITDA spreads, increasing EBITDA growth, narrowing credit spreads, and increased refinancing activity. All these phases are important because different industries and sectors and asset classes can benefit during different times of the credit cycle. So in modern times, the credit cycle defines the different parts of an economic expansion and contraction, and they're largely influenced by both monetary policy, I would also add, and fiscal policy decisions, right? Because we can see fiscal fight monetary and vice versa. So let's talk a little bit more about the recovery phase. Monetary policy works to move the economy out of a recession. We often see that as a key part of the recovery phase, right? The Fed sees the economy weakening, they start to cut interest rates, companies start to work out excesses So, they may have had too much leverage. They're going to start to wind that down in any way that they can. We see credit spreads start to narrow as perceived risks drop. And we see an economic recovery that leads to the repair phase, right? Let's talk about the expansion phase. Businesses expand, increasing their leverage. Economy continues to grow and even begins to run a bit hot. Risk tolerance increases further, so people have a heightened risk appetite. Credit spreads narrow and risk assets rise. Companies are also more likely to repurchase shares, and consumers are more likely to make big purchases. So you could say we're probably in that expansion phase overall now with how everything is playing out. Then there's the downturn phase. Leverage continues to increase. Credit spreads widen. Risk assets see greater pressure going into a bear market, defaults rise, and the economy goes into a recession. And so let's talk a little bit about econometrics. We just did a nice summary of the credit cycle, what it means, what the different components of it are. This is meant to be a very high-level presentation on macro, so really trying to fill in knowledge gaps for folks that are watching. The next one is econometrics, right? The most important econometrics to watch are things like retail sales, UOM consumer sentiment, new and existing home sales, GDP, manufacturing activity like ISM manufacturing PMI, durable goods orders. I'd also say ISM services PMI, employment like tomorrow. We've got NFP and we've got the unemployment rate as well as month over month wages, and then also inflation, right? That's been such a key driver of event volatility. We've been in this era of disinflation. So CPI, PCE, and PPI, all important to watch. And when we talk about retail sales are showing how much the consumer is buying in nominal terms. These are month over month numbers that we're getting. That's where most of the focus is. We do get year over year levels. We also get Johnson Red Book, but really retail sales is the most important number that observers are watching. It's broken down into 4 categories at the top level. You've got total sales excluding auto, and general merchandise. And general merchandise is more of the discretionary items that people are purchasing, right? So it really does help to see strength in general merchandise to get a sense that the consumer's feeling pretty good. We did see a lot of that looking back at December of last year as an example. Much more granular data is also available within the report from the Census Bureau, so you can kind of drill down into what all is happening. And there's also retail sales data, which shows what consumers are buying using inflation-adjusted data, that real retail sales, right? And that can be helpful too. Like you saw for a long time, retail sales, even though in nominal terms were building due to inflation, in real terms they were flat to lower. Because if you adjust for inflation, people were buying the same amount of stuff for more money. It wasn't like they were spending more to buy more. And that's an important clarification. Now let's talk about UOM consumer sentiment. This is another one that's widely watched. The survey has 5 key questions. I'm paraphrasing them for brevity. Are you better or worse off than a year ago? Right? They want to know how you're feeling. Do you think for a year from now you'll be better or worse off? Do you think that the next year will be good or bad financially? And do you think the next 5 years will be good or bad? Okay, so they're just getting kind of a general feel for how people are in the present, how they think they may be in the future over various time frames. They also get expectations about where people think inflation is going to go. So it's a very interesting survey. And it's one that can move the markets when there are strong deviations from expectations. That's why we're kind of going through some of these econometrics, because even though, these aren't things that necessarily translate to price discovery that same day in every instance, it does have a longer term impact. These are also important clues for how we may see earnings play out, for which sectors may be doing better or worse. So it's all important. It's all important to watch. Let's talk about home sales data. Home sales are important to watch because housing accounts for 15 to 18% of GDP. So it's a pretty important area of the market. And when you have more new homes being built, that adds to that GDP activity because it's not only the amount of effort required with selling an existing home, like fixing it up, putting it on the market, all the fees and transactional activity involved. When you're building new homes, there's a lot more economic impact as well. There's the materials, there's the labor, there's all the permitting, then there's bringing it to market and so on and so forth. So the more that's involved, the more GDP contribution that it's going to have. And new home sales show which of these have been built to buy. Existing home sales show which are on sale by their owners. Now, this is an interesting thing to think about because when the Fed raised rates as much as they did, as fast as they did, after Powell was very specific about calling the housing market a bubble and saying a reset was coming, he actually managed to get the opposite effect, because it caused existing homeowners to not want to sell. If the rates were so much higher on a new mortgage and it happened so quickly, there wasn't time to adjust. So they just basically dug their heels in. And then we're also in an economy where it's easier to have remote work, right? So people don't have to move as much. So existing homes are an area where the market is very undersupplied. And so homeowners are not really selling, so home builders are having to fill in that gap. That's one of the reasons the home builders have done pretty well, even though rates have been rising. Now let's talk about GDP. GDP is a really important econometric, and the way we do it in the United States is real GDP. So we are adjusting for inflation with the GDP numbers we get in the United States. GDP is the total value of all finished goods and services produced within a country. Growth of the GDP is often measured on a quarterly and yearly basis. Some countries do monthly too, which is interesting, but not really the US. There are two ways to measure GDP. The first is nominal value. When using nominal value, we're only looking at the total number of units in a currency for that measurement, right? So that's not adjusting for inflation. There's also a more accurate way to measure GDP, which is, again, what we're doing in the United States, although our measures of inflation leave something to be desired, but that's called real GDP, where we are netting out inflation and looking at growth after we account for those increases in price. Let's move on to manufacturing activity. Manufacturing is an important area of the economy. I also think ISM Services PMI is important, so we're going to use this slide for both, because it does apply for both. These are diffusion indices. So it's really responses about affirmation or, declining, right? So when we're looking at ISM manufacturing or services PMI, a level above 50 means expansion or an increase in activity. The closer that level is to 50, the slower the expansion. A level at 50 means no expansion. A level below 50 means contraction. The further away from 50 on the downside it is, the deeper that contraction based on that survey. And the report surveys purchasing managers across 19 industries. So it's interesting to look at. You've got areas like employment, prices paid, new orders, backlogs, imports, exports. They do get some interesting granular data. And yeah, services PMI, because services are over 70% of business contribution to GDP, they're really important to watch. And really, we've had this sort of like rolling recession in manufacturing where it's been in contraction for quite a long time, over a year, with some hiccups above. But for the most part, in contraction for that time, the whole time services they were still expanding. And prices paid for services were still on the rise as well. So it's also a sort of dichotomy of outcomes with this ISM PMI. And when we look at services PMI, when it comes in hotter than expected and prices paid are materially higher than expected, that can be one of those macro event volatility catalysts that causes rates to rise and some de-risking, particularly in longer duration risk assets like tech and growth. Talk about durable goods. A broad-based monthly survey conducted by the U.S. Census Bureau showing industrial activity and used as a leading economic indicator. And obviously, if the economy is doing well, people are buying more durable goods. They're buying homes, they're adding a refrigerator, an oven, a TV, a washer, dryer, whatever the case may be. This is an important econometric to watch for the health of the consumer and the overall economy. And then we have, as we're going to tomorrow, employment, non-farm payrolls, and unemployment, and of course, average hourly earnings month over month and year over year. So non-farm payrolls count the number of jobs created month over month. The report breaks down which sectors the jobs were created. We also get some feedback from individual states. And unemployment measures the number of people filing for unemployment month over month in a number and percentage, right? So not everyone who is unemployed is counted as unemployed. There is a time where you get off of unemployment insurance and you're no longer counted in that U3 headline statistic. It's an important clarification. And the amount of people in the labor force, how tight the labor force is, all of that has a major impact on the economy. Like right now, we're still seeing large wage growth and a rather tight labor market. Now let's talk about inflation, CPI, PCE, and PPI. The Consumer Price Index measures inflation that consumers face and is based on sample data and surveys in multiple regions. Data is broken out into 4 different groups: core and headline for month over month and core and headline for year over year. And then you go deeper and there's more data within. You can find the individual categories and get a little bit more information about what this all means, right? Like where you're seeing inflation build up for of late. As Powell remarked today, a lot of that's coming in insurance. There's still inflation in transportation and housing and otherwise. So when we look at CPI and PCE, we can see some of the primary contributors to inflation as well. The PCE inflation rate is calculated by adding up the dollar amounts of all goods and services in a weighted basket and comparing them to the prior month and year's figures. Like CPI, PCE has both core and headline metrics month over month and year over year. And interestingly enough, when you get GDP data, PCE also gives you quarterly price increases or decreases, right? So you actually have 3 time intervals for PCE, making it a little different than CPI. Now, we also have PPI, which is the Producer Price Index. It measures the rate of change for input costs incurred by domestic producers for their output. It has both monthly and yearly measures as well as headline and core numbers. The core numbers in these measurements net out more volatile inputs like energy, and for the case of CPI and PCE, food as well. We're going to take a quick break here, and then we're going to move right on to event volatility catalysts. If folks have any questions, feel free to drop them in the chat. All right, we're going to resume here. No questions so far, but if any do arise, feel free to drop them in the chat, and I will try to get to them. So we're going to talk about events, and we're going to talk about how those can be volatility catalysts. I think this is an important topic to discuss because this is something that we see as sort of a recurring theme, right? There are things like OPEC meetings, Fed meetings, when different earnings events happen that are big enough that they can move the entire market, not just single stocks. All this kind of stuff is important to contextualize, and it's important to understand that it's not just the event, but it's also how the market is positioned before the event. So let's talk about event volatility catalysts and why they matter. Whether it's an OPEC meeting, economic data, major company earnings, a Fed meeting, or another event, if the market is watching, then it may drive price action. And the market's pretty much always watching, right? Whether it's humans or bots or some combination of the two, there's some degree of reaction function for events that are important enough. That's one thing that I think that we can all agree on. How price is impacted can depend on how participants are positioned ahead of the event. This is important because a lot of the time when the event is known, when it's scheduled in advance, there's going to be some degree of event risk hedging, okay? So understanding that dynamic can explain some of the otherwise somewhat counterintuitive price action that you could see. Because if you're hedged into an event volatility catalyst and that it ends up being not as bad as you expected, but maybe it's still kind of bad, you still have folks removing those hedges. So in the case of, say, equities in the stock market, that would be people covering shorts. So even if you get like a somewhat bad but not terrible data release, you could have the market rallying because people are covering, and they're covering because they're saying, well, wasn't as bad as it could have been. So we're going to move out, we're going to take our hedges out, and we're going to hedge out the next catalyst that we see on the horizon. So let's talk about a classic event volatility catalyst. I actually traded this when it happened. It was a rather extraordinary day. This was, I believe it was October 13th of 2022. This was one of the most violent reversals I had ever seen in the S&P futures outside of, say, the great financial crisis and COVID. And this was one where CPI was sold into aggressively because traders were not well hedged into the event, right? But they got so aggressive on the selling, they got caught off sides. And we saw an absolutely incredible reversal. One where liquidity had dried up so much that the volatility, it didn't take much volume to really push all those sellers off sides and force them to cover at higher and higher prices. This ended up marking the interim bottom and then the longer term bottom for the market because of that powerful head fake and the resolve of buyers. That they were just basically saying, look, you know, you guys are so off sides, there's no way that we can't allocate in here and push the shorts out. And indeed, from a tactical trading perspective, they did just that. And it was a sight to behold. So many gains also happen when the market is closed, right? I mean, think about that CPI day, for example. Those gains were happening, a lot of it, before the market even opened. This sort of float higher after hours. This is something that's been a kind of routine part of the markets until maybe the last several years. It hasn't been quite as prevalent with the rise of options. Some of that price actions taking place more during regular trading hours, but nevertheless, for the better part of, say, 30 years, most of the appreciation in equities was happening after hours, due in no small part because of some of these event drivers, right? You'd have earnings, you'd have economic data, you'd have various policy announcements around the world, and in other auctions like the European and Asian auctions, there'd be developments. So look at how much you would be up on S&P, not including dividends, if you only own stocks during regular hours and sold after, you know, into the after hours. You'd basically be flat to down over 30 years. But if you were only holding during outside regular hours, you'd actually be up close to 600% in that same time. So that's another reason just to kind of look at these event volatility catalysts with a little bit more attention, in the sense that they are big movers. I don't know that they're quite as big these days as they were back then, but I still think they're quite important, as we talked about with that CPI example, particularly in the more extreme scenarios. So let's summarize why event volatility matters. Because they are powerful drivers of short and even intermediate term price discovery, how the market is positioned ahead of an event, as well as what happens during the event, can help both traders and investors better understand how and why that market is moving. It's also important for managing our own risk. For example, it may be dangerous to go aggressively long into a poorly hedged market, just as it may be dangerous to go short into a well-hedged market. So we're going to take a brief break, and then we're going to talk about what hedging means for price discovery. And again, if you all have any questions, let me know in the chat rooms. All right, so let's dive right in. First, let's talk about smiles versus smirks and why the shape of the volatility curve matters. So let's go back in time a little bit here. The 1987 crash changed how hedging is done. It changed calculations behind value at risk. And so since then, the S&P 500 has always had a smirk towards put premium. Let's translate that into English. So since the 1987 crash, risk managers had to be more stringent, more rigorous in how they managed risk. Part of that meant put positioning in SPX or S&P 500 index options has always exceeded the amount of demand for call positioning because of that demand for insurance. So understanding skew dynamics, particularly at the index level, but also in single stocks, can give us a better sense of positioning, can give us a better sense of how well hedged the market may be as well. So in asset classes outside of the US, a smile implies a poorly hedged market, and a smirk towards call premium suggests some degree of bullishness, if not euphoria, if we start to see extremes like what we're seeing in the SMH Semiconductors ETF or NVIDIA, right? Right now, there is some euphoria. I posted a chart about that today on my feed. And so really what you're looking for in the S&P to get a sense as to the amount of insurance that's on is the amount of skew towards put premium and also the relationship between implied and realized vol, right? If implied vol is higher than realized vol and there's plenty of skew towards put premium, you're in a reasonably well-hedged market. However, if realized vol is higher than I vol and skew is low, then you're not in a well-hedged market. Those are two pretty simple ways of looking at it. Obviously, you can go more quant and you can look at this with a much greater attention to the variables. But for us traders out there that just want to look at two data points, I vol versus R vol and skew versus positioning is a good way to get a better sense as to hedging. So let's move on to fiscal policy, because fiscal policy can and often does have a major impact on on the economy, but also on financial markets, quite frankly. And we've seen that more recently with the Chips and Science Act and the Inflation Reduction Act really stimulating a lot of construction, a lot of manufacturing reshoring. But we've also seen in the past, and we're going to look at some of these examples from the great financial crisis. Policy may have a big impact on markets. How the government allocates its budget can and often does have a large impact on the industries in question. Preferential treatment, or what we call kingmaking, of specific companies, as well as subsidies and other forms of favoritism, can create winners and losers. It can also hinder innovation, free market competition, and so forth. An example of how this has happened in the past is, let's look at the great financial crisis and the kind of bailouts we had out there, choosing winners and losers, deciding Lehman would fail, Bear Stearns would fail, Morgan Stanley would, continue, Goldman would continue, Citigroup and Bank of America would continue, but there'd be some forced marriages between companies like Countrywide and Bank of America, Bear Stearns or what was left of it, and JP Morgan and so forth. That choosing winners and losers is kind of the antithesis of free market capitalism, but nevertheless, it's a huge domineering component of fiscal. We have to be aware of it because you can be playing a game and you think you understand the rules of the game, and then this type of stuff happens and the entire rule set of the game changes and you have to adapt very quickly. So policy impacts on the market. During COVID, the government passed enormous spending bills, putting over $5 trillion into the U.S. economy. That was expected to boost GDP by 4.7% in 2020 and 3.1% in 2021. It added $2.3 trillion to the deficit in 2020 and $600 billion to the deficit in 2021. So that growth came at a high cost. The net result was these spending bills drove an enormous amount of demand, and this was at a time where we had shut down large parts of the economy, and when we started to reboot them, there was still a lot of bottlenecks in these supply chains. And because those supply chains were as constrained as they were, demand exceeded supply, and that began to create some of those powerful inflationary effects that we started to realize by 2021 and going through 2022. And most of that money went to people and businesses, $1.8 trillion to individuals and families, $1.7 trillion to businesses, then another $745 billion to states and local aid, and about $482 billion to healthcare. So this is one of the reasons why we saw this. It's just absolutely extraordinary surge in the demand for goods and later services, right? There was just so much money flowing through the economy, it had to go somewhere. And fiscal policy then, as a result, as we're talking about, it drove demand, it drove inflation. So this is another situation where you see a macro factor, it's playing out, and it has real world economic and market impacts, right? There are obviously ways as traders and investors to benefit from this inflation. During periods of inflation, because we measure earnings in nominal terms and because margins tend to expand as companies raise prices faster than the rate of inflation, there are opportunities to realize benefits from earnings expansion, which indeed a lot of companies did. So this is something that I think is important to take into context because you can play it in commodities, you can play it in companies. As you see inflation accelerating, there are a lot of cyclical areas that benefit from it. And this is also kind of being aware of where we are in the credit cycle and which industries and sectors benefit from that. So fiscal policy impacts post-COVID. There are attempts to further drive demand from the CHIPS and Science Act and now the Inflation Reduction Act. Rather than extending supply, really, the immediate effects were increasing demand. This is essentially fighting the Fed, as the Fed does want to destroy demand and reduce inflation while the government is driving demand. If the government was instead helping to alleviate supply chain constraints, particularly in energy and base metals and ag and otherwise, that would probably have lessened the need for the Fed to have been as aggressive as they were during their hiking cycle. So we're going to take a brief break and then we're going to talk about geopolitical events that can disrupt economies and markets. As always, if anyone has any questions, let me know. All right, let's talk a little bit about geopolitical events and how they can drive price turmoil. We're all familiar when Russia invaded Ukraine. We saw incredible upside volatility in ag, in energy, in metals, and in other markets. Really, volatility across the spectrum increased. We saw, then margin requirements increase, which reduced liquidity because it became more expensive to participate, and that further increased volatility, right? So it's kind of like a vicious cycle when you start to see that kind of the exchanges cracking down on margins during a time of high volatility. It kind of exacerbates it, right? Because you have less participation, it takes less volume to move price more. So during that time, in particular, oil, European and Asian natural gas, corn, wheat, and palladium were impacted. They all kind of just kept surging, particularly natural gas. In Europe, it went absolutely bonkers because it was essentially assumed they weren't going to get nearly enough, and we were still in a pretty cold period of time, right? So it was a time where there was resurgent demand for natural gas. So that was one of the reasons we started to see more impetus for building LNG terminals and exporting natural gas. But nevertheless, this was a lesson, right? This was a very interesting one too, because the immediate impulse from the ECB was to start cracking down on speculative trading. They started blaming traders for the price spikes, which is actually patently unfair. And it was kind of cool because Aisha was invited to present. She's a co-founder of MacroVisor and Traderade I. She was invited to present in front of the ECB on this exact issue, and she advocated for us, for traders, right? But she did so driving her case with data. And the data said very simply that the less people that are participating in a market and the more attempts there are to fix prices, the more likely that price outcomes will be less and less ideal for people. That you really do want liquidity providers from intermediaries, from traders, from speculators, that yes, there will be times of volatility, but without them, and with attempts at price control, it's more likely that prices spiral out of control and supply and demand imbalances become more distorted. And so it was pretty cool. It was an honor that she got invited to present that. And as a result, we still see them considering that framework, but they have not moved forward with trying to severely curtail trading in commodities, which is a good thing because trading commodities is actually important. When we're trading commodities, we're providing liquidity to that market. So the invasion led to a huge grain price spike as well. This was an absolutely insane trade in wheat, corn, and in barley. Because Russia and Ukraine are the breadbasket of Eurasia, the invasion of Ukraine led to a large amount of supply becoming unavailable or potentially sanctioned. This also benefited U.S. producers of the same grains. As prices rose, there was a lot more crops planted, which has now led to an oversupply. How about that, right? We got real excited, planted all these crops expecting this longer term duration. Now we have this longer term oversupply, and that's why prices of these same grains have rolled over. So, it's been said in the past that high prices lead to low prices and low prices lead to high prices. And the reason is you have high prices, you get a lot of people incentivized to add supply, in this case, plant more crops. And then when you get real low prices, you get less people wanting to plant. So there's less supply and demand comes back. You go back to high prices, right? So it's kind of like this cycle we see in the commodities market time and time again. Oil prices also ramped up during the war. And we can see that here. This is just a part of it. Really, they went all the way up to, I want to say about 125. Remember, oil prices were negative in March, April 2020. They went all the way up to 125 during this war. They've settled down now, just hovering below $80 on West Texas Intermediate crude. Nevertheless, that was an enormous spike. Energy companies benefited, oil ETFs and the commodity benefited. There were a lot of trades in this. So it is important to be aware that also as traders, even though these are risk catalysts, in one sense, there are trade opportunities in parts of the market that are beneficiaries. In this case, energy producers, refiners, oil ETFs that gain exposure to the commodity, the CL, and then the micro crude contract as well. And so we can see here, rising oil prices benefited energy companies. They had one of their most profitable years because of those rising energy prices. We can see it with ExxonMobil, Chevron, and ConocoPhillips. And energy stocks are the best sector last year, right? I'm sorry, this is now 2022. So really, best sector in 2022. Time flies when you're trading markets. And that was an area of the market where the rest of the market was rolling over rather than, outside of like healthcare with Eli Lilly and some of these other areas of the market, energy was an outperformer. Even though oil actually ended flat overall in the year, energy still killed it. So, when you see those catalysts and they have that earnings impact, that huge margin expansion, those are also catalysts for sectors and industries. And it has everything to do with the big picture, with what's going on in macro. So geopolitical tensions can and often do create opportunities. John F. Kennedy once said the Chinese use two brush strokes to write the word crisis. One brush stroke stands for danger, the other for opportunity. In a crisis, beware of the danger, but recognize the opportunity. And I think that's an important thing to contextualize what we saw. Yes, it was a frightening time. Yes, there was a lot of volatility in U.S. stocks, but there were still plenty of opportunities. So we're going to take a brief break, and then we're going to talk about extremes in market dynamics leading to important turning points. If you have any questions, let me know. All right, moving right along here. So extremes often tend to lead to mean reversion. When we see an extreme in short positioning and or put open interest, it can sometimes lead to a powerful mean reversion rally because selling interest becomes exhausted. Similarly, an extreme in long positioning and or call open interest can lead to a mean reversion lower as buyers exhaust their resources to push the market higher. These mean reversion moves often manifest in retraces that are close to key Fibonacci levels. Once a counter-trend mean reversion completes, the primary trend is likely to manifest itself again. Extremes in breadth are also noteworthy. I like using the Nicey-McClellan oscillator, the NIMO, and the NAMO, the NASDAQ-McClellan oscillator. You can start to kind of get an idea of what regime you're in and where the extremes are. But often for the NIMO, I'm looking at highs over 80 and lows under minus 80. They can lead to short-term reversals. They can sometimes show you periods of exhaustion. Extremes in options flows are also important too. On screen, you see an extreme in pessimism. This happened around the time the market bottomed in late 2022. There was an enormous amount of demand for puts in single stocks. Now, why do I use the CBOE equity put call ratio instead of the entire put call ratio or the index put call ratio? It's simple. Because I feel it's a little more pure as a measure of sentiment. Earlier, we talked about skew and the persistent demand for SPX puts, or S&P 500 downside protection with options. Well, that means there's always that flow, and that distorts the index put-call ratio. So I'd rather look at just equity put-call flows because I get a better sense as to how participants in the market are feeling who aren't sort of compelled to buy puts on the index, right? So when you see these huge spikes, the other one you can see in the very beginning of the chart was in March of 2020. That's showing you there's an extreme in pessimism and fear. Those extremes often resolve, and when they resolve, they often resolve with a reversal higher in the market because there's really not a lot left. Like at that point in 2022 and at that point in 2020, when this extreme was hit, we had a lot of single stocks skew towards puts. Put premium was very, very in demand at the index level, but in single stocks as well. And that actually helps to buffer against downside, right? Because when that positioning loses value, those dealers are buying back those shares. That becomes liquidity positive. So the more people are buying fire insurance, the less likely it is that the building is going to burn down. That's just kind of how things work. So positioning is often more important than sentiment, but I think sentiment is still important to watch. Sentiment surveys are helpful guideposts to determine how different groups of market participants feel about current and future conditions. But positioning often tells a different story, and in my opinion, it is more important to watch because you can feel one way, right? Like you can see AA, retail sentiment say one thing, but then maybe people are super bearish, but they're also still long through the teeth. Because often, folks like us, retail, aren't really shorting the market that much. So we could feel bearish going out 6 months, which is what the AA survey measures. But then that may not matter because we're still, positioning-wise, we're still quite bullish in our positioning. So that's why positioning is kind of the truth. The truth is in the math, right? Where are people actually putting their money rather than how do they feel about the present and the future? NAIM tracks active investment managers. That's why I like to show that survey data regularly. It comes out every Thursday, so it came out today. You can find it at NAIM.org or on stockcharts.com using !NAIM. And that way you can see some of these extremes, like over 90, which we are right now. That is an extreme of bullishness. That positioning is a little bit lopsided to the long side. I also like to have a single chart where I break it all down. So I have a chart where I have volatility, I have credit spreads, I have the NIMO, New York Stock Exchange McClellan oscillator, CBOE equity put call ratio, NAIM, and also RIDEX bull bear fund demand, right? So all of that, one chart, looking for convergences. This has been a big theme with me the whole time, finding convergences, using them as a bit of a compass, whether it's liquidity and options positioning and flow, or various measures of sentiment, flow, and positioning. All these are things that I like to contextualize and build into my process. So we're going to move right along. Just going to take a quick break. The next subject and the last area of slides, we just have 6 more to get through until we're done. Central banks set the tone for markets and the economy, at least usually, right? I'll be right back. All right. So, one common thing to say, and it's worked until probably the last year or so, is don't fight the Fed. Central bank policy often has an enormous impact on price discovery. There's generally a strong correlation between balance sheet size and risk asset performance. So QE is often an elixir for asset prices, QT often the opposite. One countervailing force of late has been the enormity of fiscal policy outweighing monetary policy impact. So not so much that we, the market participants, are fighting the Fed as much as the government is fighting the Fed. And then there's some countervailing impacts from the People's Bank of China and the Bank of Japan. Nevertheless, liquidity is important, and central banks tend to provide a lot of it to the markets, to the economies. It's really about how much they're providing to bank reserves and how that eventually permeates into different assets. Of late, however, the Treasury has been having an enormous impact here because all of that fiscal deficit spend also enters bank reserves, so it has a similar elixir effect as QE. The wealth effects are central banks reducing the cost of capital and adding liquidity to markets. That creates wealth effects by rising asset prices, whether we're talking about real estate, stocks, bonds, or even things like crypto that are sort of more speculative relief valves for excess liquidity in the financial system. Eventually, these can become asset bubbles, and those asset bubbles can create further wealth effects that stimulate demand. If you have more money, you're going to buy more stuff, bigger house, fancier car, travel more, etc. If demand is too stimulated, it can lead to inflation. Therefore, the Fed does what they can to reduce wealth effects periodically, especially when inflation is running hot. Now, when we do see liquidity drained, when there is an actual reduction, and that is likely to be something we see as the reverse repo balance runs lower, for example, that can lead to higher volatility, right? So that's something to take into consideration as we get through this process and get closer to when the Fed will start cutting again, probably July, August of this year, maybe cutting twice. I think that might be a reasonable expectation. We may see actually counterintuitively a little bit of volatility for the reason of policy transmission delay and the reverse repo running lower, bank reserves starting to run lower as well, and some of those positive fiscal effects running off as a lot of that spending has, the big chunk of it has already been underway. So I'm going to cap my presentation here. I hope this has been helpful to everyone watching. For those who want to learn more about my work, visit me at MacroVisor.com to learn more about long-term investing research and institutional consulting services. Check out Traderade.com to learn more about my swing trading ideas, education, coaching, and the tools I built to help traders out there. Visit my YouTube at youtube.com/@mayhem4markets to check out my other educational content. And follow me on Twitter if you don't already at mayhem4markets. That's mayhem number 4 markets. And thank you so much, everyone, for tuning in. I'll catch you soon.